Good morning, everyone. Welcome to today's marketing webinar. I'm Jaden Elslag, and we got Jeff who's with us today talking about hogs. Just a reminder, our next webinar will be June 23rd at 9 a.m. Just a reminder, everyone, we have started this riskology series this year every third Tuesday of the month. That is on our new YouTube channel. So check that out. It's just for people new to this industry and that want to learn more about kind of what we do and kind of the products we offer. And this next one will be the June 16th, and that will cover LGM. And Jeff will take us away on the hogs.
Perfect. Thank you, Jaden. Yeah, looking forward to the LGM discussion. That there are some new rules there where it might be a little bit more applicable going forward after the July 1st change. So, one of the big reasons we haven't used it in the past is you couldn't use LGM and LRP in the same month. So if we used LRP, which I think most of our customers know we're a pretty big fan of in the hog business, in a certain month, that eliminated our ability to use LGM. That will be changing here as we turn the beginning of the month. So I think there might be some more application there. So check that out if you get a chance. We'll get into pigs here a little bit. And I want to throw a little bit of a warning, maybe a little of a pre-communication here. I mean, we have a little bit more negative information that we're going to throw out there today, and I don't want the audience to think that we're doing a complete 180 on what we think this market looks like. We definitely have some maybe some different looking information today than what we've shared with you in the past, and it'll have a different tone. But the reality is it's June 9th today. And we aren't seeing much of a rally. So we have to, at some point, we have to start to accept the reality of the situation that we're in, and this thing is just not getting off the ground like we had hoped it would. So what we wanted to do today is talk a little bit about maybe what are some of the factors that could be turning out differently here so far this summer than what we maybe anticipated a couple of months ago. So first thing we have up here is the June chart, of course. Obviously, a pretty ugly looking chart. From a technical standpoint, we've been getting into some sell pressure throughout the past weeks. Of course, anybody on the momentum side of this thing, momentum trading would be continuing to have success on pushing it lower, right? And those red and green lines really represent just the downward trend that we're in, and that thing has held extremely well. Tested the lower side of there about a week and a half ago and caught a little rally because of it. Next thing we're going to look at, and this would be the June chart, is the green line on the bottom there, and that might catch a little bit of strength as we continue to trend lower towards it. So here's the CME index, and I wanted to compare these two slides, of course. One of the big things that we're looking at also is that June board, trading in that $94 range, and the index here finally starting to get some good news and trade just a smidget higher into that 92.5. Probably going to see it print over 93 yet, even with yesterday's big down in the cutout. So my point with that is we're getting the summer futures very close to where the current CME index is at, right? So it's one thing we talk about quite a bit is like how much premium is in the marketplace, or how much optimism, how much pessimism. Today, looking at June, I understand we're getting really close, but it also is relevant to the other summer months. We're getting very close to where the CME index is, hardly any premium into these markets. So, July sits there $3.50, $4 higher than the June. So you could argue that's got some premium in it. August does not have much, down a couple dollars lower than the July, a couple dollars higher than the June here. So not a lot of good news priced into this marketplace today. I don't have the chart of the fund position, but that is they've liquidated big time in the past few weeks, as you can imagine. Managed money is now short. and that does not happen very often. It doesn't happen to a very large extent. I think the largest they've been is around 30,000 contracts, and they must be nearing 15 to 20,000 today would be my guess. So there's some, I don't know if I can twist that and say good news or not, but in my mind, that is kind of good news. Like we've got a lot of negativity priced into this marketplace. Go ahead and jump to the next slide there, Jaden. Just wean pig market real quick. This has been, viewed as some indicator of tighter supplies to come, and I think that storyline still continues. We are seeing this drop fairly rapidly here, but some of that is going to be a little bit more supply available. The other portion of it, just December futures continue to drive lower, of course. So we'll get into some of the here and now as far as the supply side and product values are concerned. So kill rates last week, exceeded our expectation just a smidgen, 2.43 almost. Thought for sure we'd be over 2.4. We had a little bit more kill there on Saturday, I think, making up a little bit. Also going to be over 2.4 this week. Current estimates running in that 2.41 area. Same thing. We've had some processors struggling here in the weeks past, and one of them is going to make up a good shift here coming on Saturday. So this week's going to also be a little bit bigger than what you'd like to see compared to last year. So I think that storyline is probably going to continue here for a couple weeks. We're just carrying quite a bit of weight on these pigs. And we've got the pigs that need to work through the system, and we're getting busy trying to get that done. I would draw your attention back to, about 2-3 weeks ago, we did show this marketplace some fewer numbers, and some of that was accidental. We had some breakdowns in there. We had, right before the holiday, we had some issues, and that's now what we're trying to get made up here as we go into the first half of June. But as we start to look at some of the primals and some of the cutout levels and stuff, I do want us to keep in mind we are putting quite a bit of product out there today, but back that up a couple of weeks, and we did show the marketplace some lower numbers, some lower pounds of meat coming out of the backside of these packing plants, and we really didn't get much of any life from the product value standpoint because of that. And that's, really where some of our concern on this marketplace started, and we haven't got just a ton of good news since then. So pork cutouts been largely flat. We were able to see some uptick week over week if you want to look at Friday's number, and that's the last one on the chart here. Of course, yesterday took a lot of that away with being a couple bucks lower. So definitely seeing some volatility and back and forth, and a lot of volatility between the different primals also. We'll see what happens today. Hopefully we can start to build something here and have an update again. Today it's just, we got to get all the primals to kind of align a little bit where what we've been seeing in the past few days is some up big, some down pretty hard. Net results, been pretty volatile. We're going to jump into exports first and just kind of cross that off the list of things to be worried about, quite honestly. This category of the demand is going extremely well. We've had better than expected exports for quite some time here. I know we've reviewed this, so I'll try to make it more brief. The charts that we're specifically looking at here is the weekly numbers that come out on Thursday. Those are the muscle cuts. Had a couple 6 good weeks there, kind of in the March, April timeframe. Been a little off the last 2 or 3 weeks, but don't think it's any reason for concern. You go look at some of the bigger numbers on the lower left-hand side of the screen there. Compared to last year, 22% higher on total, and you can see some of the bigger customers there and some of the expansions that we've seen in those marketplaces. Been focusing on Mexico a little bit extra hard since the pseudorabies event happened. It's growing on a month ago now, so that's the good news. That thing is pretty well quieted down, and most likely for good reason, right? And June 12th is supposed to be when we're doing our last testing for that, and if we don't find any positive situations, that should continue to fade into the background. But it has been on our radar, as Mexico said they wanted to, you know, scrutinize or limit the offal products after that event. So far, we haven't really seen any backlash there on the muscle cuts. So 37% versus last year. That looks in good. That's year to date, of course. This next chart shows more of the weekly progression here, and yeah, we're seeing Mexico slide just a little bit, but here again, I don't think there's anything for any real huge alarm on this one. So we'll get in and talk a few primals, and on the Mexico discussion, of course, we want to bounce over and look at the ham situation. One of the primals that's been performing decent here. We're still hearing about good buying coming from Mexico. So it seems to be one of the good guys as far as the primal situation is concerned. The belly market obviously had been one that we've been struggling with a bit. And we've been hearing lots of reasons maybe why bacon isn't moving quite as well as what we'd like it to. It's also primal that should take care of itself as you go further into the season here, right? We will get into some fewer numbers. It's just the right time of year to do that. We'll take some weight off these pigs as we get into some heat and kill a few more of them. That should all work fine. And that, as we all know, this belly situation is certainly a market of have and have not, right? If you get a little too much of it, it gets pretty soft. You start running out and get a little short on supply, which we usually do in the month of July. It can rally pretty hard. So I think we'll see some nice rallies in this belly. No doubt, been disappointing so far. The ribs, as we look thinking about domestic demand, ribs is one of the things that comes to mind. And this is performing extremely well. One of our big concerns on this one, and this is some of the back and forth like I'm talking about. We might have some days where you have some up days on the belly, but then a down day on rib. And if you look at the seasonality of this chart, it gets concerning, right? This could be one of the reasons why products continues to disappoint us a little bit. We might get some of the primals that we're concerned about off the mat and starting to rally the way they should, but we might come right into the time frame here on ribs where they might struggle a little bit. And as we continue to look at kind of the bigger and macro situation, I think it's part of the reasons why the funds have liquidated out of this hog market so hard, are some things like last week when we saw a really good jobs report. But, the marketplace, as you think about the stock indexes and the U.S. dollar index and things like that, all traded negatively to that because of, the countermeasures of maybe a higher interest rate or certainly less of a chance of a lower interest rate. So I think some of those demand factors is maybe why the funds are getting a little negative on us here. Beef product values. This one's continues to be interesting, right? But one of the things that we were hoping that we would see is a seasonal rally during the month of May and going into June here. And maybe it's a little too much to expect. I mean, as you look at these lines, beef product certainly doesn't have any problems, right? Much higher than a year ago. Sticking around that $395 to $400 on choice beef is nothing to be ashamed of. But the decrease that we have seen in the supply side, you would have liked to see this spike a little bit more. another thing that we have on the list is as a potential concern from a domestic demand and spilling over into the pork complex. So we've done a little bit of recent work here in the past couple of weeks on, okay, let's think a little harder about competing proteins. We obviously understand that beef is higher, continues to work higher, just like we saw. This chart narrows it down a little bit more. It's looking at the high lean, 90% trim. So trying to, picture the base ingredient for most of the ground beef that's out there in the retail front, right? Chicken breast is going to be the blue line, and then the pork loin going to be the green line. And historically, these are three of the more common products that we believe the consumer would be willing to switch in and out of based on price and a pretty common level. It's not the real high end stuff, the ribeye steaks and so forth, right? So obviously the beef one doesn't surprise anybody. The blue line on chicken breast, that one is where we're spending some time and thinking about. Those folks have been able to expand here recently in the tune of 2 or 3%. So not huge expansion compared to what we're seeing in the beef complex, but appears just in the past couple of weeks at least, it might be enough expansion to start taking some of the poultry prices lower. And maybe that is another thing to put on the list as we, look at where we're at in the pork complex right now, and might help describe some of the frustration we're feeling as far as how slow we've been to catch our summer rally here. So to start wrapping this up a little bit, obviously futures have fallen off a bunch. This is a forward margin look into next spring. Really, these aren't terrible. As much as we've eroded the futures prices on the hog side of things, we're still showing, $13, $14 on our generic sheet. So it's not terrible prices. It's not the $30 stuff that we saw. We're feeling pretty good, I think, as a general rule about our coverage today. We're probably not going to be pushing too hard into next spring and such. And I would just say, part of what really has made this hog thing work is lower grain prices. So we are focusing on that, and going to be continuing to want to take some action on that side, at least to secure some of the prices that we've been exposed to here recently, and see if we can't get a little bit better news to come in the pork side of things.
So now I'll start on the grain side of things here. So as we're about a month and a half into the growing season here for the U.S., we're starting to look at crop conditions. So overall conditions look pretty good across the Corn Belt. Just looking at last night's report, we were about 67% good to excellent on corn. And that's a little behind last year, about 4% behind last year, and a couple percentage points behind the 5-year average. And on beans, same thing as well, 65% good to excellent, just a little behind the 5-year average there. But as we talk through people throughout the Corn Belt, I would say overall that Minnesota, Iowa area, very strong compared to normal. Their good to excellent score is about 5% ahead of normal. And then maybe the problem areas, if you could complain about any areas, where maybe Ohio and Nebraska. Ohio has received a lot of rainfall, maybe didn't get planting like they wanted. In Nebraska, just, kind of got all their rain at once and were pretty dry earlier in the growing season. But nonetheless, crop conditions look pretty good throughout the Corn Belt. Jumping into some fundamentals here. So starting with ethanol, really no big changes week over week there, but accumulated year to date running about 100% of that 5.6 billion USDA forecast. So would expect USDA to kind of keep that number, and we're running right along with the USDA's requirement there. Exports for corn continue to be great. So accumulated sales are a record high, about 3.22 billion bushels, and that's 5% ahead of the pace we needed for the USDA forecast, and that's up 25% versus a year ago. And that is also with no China business there. And as we all know, a few weeks ago when China did say they're going to buy some ag products there, there is, rumors, is corn going to be involved, but we'll see there going forward. But nonetheless, we are shipping a lot of corn, and that's nothing has to do with that being China. Soybean crush there, so that chart still really sticks out there. So with last week's kind of sell off in the soybean complex and meal and oil kind of staying pretty strong there. So that's up 350% versus last year. I mean, that's a pretty big number. Stands out to me there, but helps with soy oils still near 3.5-year highs here. So the crushers are making about $4.50 a bushel there. Soybean exports, kind of a different story from corn. The USDA has had to bring down that number there. So we're about running about 1% behind to reach that pace there. So a lot of that export progress has been to China, about 35% of it. So continue to struggle to find places to ship our beans to, but with the crush pace we've been having, we have been making up for some of that lack of export progress with more crush demand there. Soybean meal, continue to see great demand there as well. As we're starting to crush more, obviously we're making more meal, but we're finding places to ship it to. So the USDA is projecting about an 8% increase versus last year on exports for meal. And right now we're running about 18% higher than last year. And you can see in the bottom right-hand corner there, kind of the destinations that are really picking up the slack there. So as you can see, Mexico, big buyer of corn. One of our largest buyers of soybeans and also meal there too. So really helping us out there along with Colombia, the Philippines, and the EU. Just looking at weather quickly. So the drought map last week, there is some drought creeping into Iowa, some of the I states into Minnesota there. But with the rain we have received over the last 7 days, maybe that put that story to rest for now. A lot of the drought areas that maybe we're getting to a little drier and a little more concerning. We did receive rainfall in those areas, especially in Nebraska, eastern South Dakota, and some of southwest Minnesota here locally. And over the next 7 days, as you can see here, widespread rain across most of the corn belt there. So right now, there's really no weather premium into the market. And last week, the large sell-off we did see probably was due to a lot of, good weather forecasts and the great amount of rain we have received so far through most of the corn belt. And temperatures as well over the next week or so going to be below normal. So any crop stress that maybe we could receive over the month of June, that's probably going to put that to rest with below average temperatures, really no above average temperatures over the next week as well. Kind of the big thing we've been looking at in the grains is the outside money flow. So the commitment of traders, like Jeff talked about it earlier on the hogs, but corn shedded about 90,000 last week. So that's as of last Tuesday. So we lost another 20 cents on corn to the end of the week there. So we would estimate that number on corn that managed money long to be around 0 or flat. So they went from around 350,000 long there in April or March, dang near record long, and now we're flat. So lost quite a bit of money flow through most of the ag complex there, along with soybeans and hogs and some in there in cattle too. And just to put it in perspective, how bad of the last week, I guess the corn sell-off was it was the worst June start for nearby corn futures since 1973. So lost 29 cents there last week and 65 cents on the beans there last week. And just looking at funds last year, I think it's just important to note, last February when we put our high in the corn market for DEES25, we did reach around the same long level for funds, about 350,000 long. And by July 1st, we were already 200,000 short. So it'll be interesting to see if the funds can follow the same pattern this year. Expect them to be pretty flat to neutral right now. So it'll be if there's really no reason for them to buy this market, whether there's no China deal to buying U.S. corn or no weather hiccups there, you could expect to see the kind of the same thing over the next few months here. And just the broad commodity complex as a whole, as you can see there around that May-June timeframe, we tend to hold a pretty long position, and it's really tough for the managed money to kind of hold a really long position past that point. So as you can see there, we were a record long across basically all the commodities, the corn, soybeans, meal, wheat, livestock, and such. So as we get into the seasonal time frame, they do tend to take some profits on unload their longs here going into the summer months. So looking at the December 26 corn chart, so we did finally find some support yesterday morning there around 441. There was our low, but if you just draw that trend line from our low all the way back in August of 2024, did find trend line support there, but nonetheless, I think without any weather hiccup or any China trade deal, like I said earlier, it's really going to be hard to find some momentum for this market here going forward, as our carryout is pretty large from last year, and it looks like this year, there was a lot of suspect whether that 95 million acre number was going to be the smallest print we see, but with talking with producers and such, it seems like that number, we shouldn't see that number get too much smaller here in this June acreage report at the end of the month. There is a WASDE report Thursday. Just briefly touch on that. Don't expect any big changes there. Normally in June, they don't make a lot of changes. With how good the weather's been, don't expect any production changes there on yield or anything like that. Maybe they could bump up exports on old crop corn, but other than that, maybe make some minor adjustments in the South America crop estimates there. Maybe bump up the corn and soybeans for Argentina there, as they've had some success harvesting their crop over the last month. Well, just looking at seasonals, this kind of stands out to us. We continue to beat the drum on this. As we're kind of in the middle between that peak in the first week of May and the third to last week of June there. So seasonals kind of, we got about a couple of weeks to try to trade some weather here, but nonetheless, after that, we kind of trade lower the rest of the year. So that's just kind of conversations we've been having with end users and row crop producers over the last few weeks here. So kind of, maybe traded some more premium earlier in the weather cycle here, and then over the last few weeks, we're kind of putting that trade to the rest here, that inflation hedging and such. So we'll see what weather brings over the next few weeks here, but right now it looks pretty good. And that's kind of all we had today. Let us know if you have any questions. You got anything else to add, Jeff?
Nope, I don't think so. Thank you, everybody.